Depends on what you have, I guess.
Good evening. Thank you for being here tonight. My name is Lucas Zambaldi, and I'm serving as the portfolio manager for the Roland Investment Program. Today, we are joined by our student trustees, Rafael Nortov, Chris DeGans, Peter Linder, Jimmy Dean, as well as our faculty and alumni trustees, Dean Miro and Mr. Stephen Alexander. I would like to acknowledge that if it wasn't for the generosity of the George family, we would not be here today. In 1980, Sarah George donated $500,000 for the creation of the program to honor her late husband. Mr. George's vision was the failure as well as success would be an integral part of the teaching and learning enterprise. One of the main missions of the Roland George Institute is to give back to the community. In order to fulfill this mission, we're here today to share our investment knowledge and techniques with you, the public. This year, we're slightly underperforming the benchmark, and this is primarily related to one outsized position that had originally increased more than 500%. Throughout the last 12 months, however, this position has been subsequently falling to the point that we're now only up 250%. Not that bad after all. However, it did cause our portfolio to lag behind the index over the last calendar year. In fact, if it wasn't for this position, we would have been performing in line with our benchmark. We use the first part of the semester to evaluate our portfolio positioning and our sector weighting. In doing so, we have gone through the investment policy statement where we identified what we believe to be the fastest growing sectors. We also reevaluated our current holdings through the wholesale process in order to free up capital so that we can invest in our chosen areas. Our theme for tonight's presentation is Florida-based companies. Let me tell you why we chose companies close to home. Florida gives a surprisingly large pool of companies to look at across a variety of industries. We believe that Florida is a fast-growing sector mainly because of its population, which is the third largest in the US, and its population growth, which is one of the highest among other states. Florida also offers substantial tax credits to businesses, which creates a friendly business environment for corporations. Due to not having a state income tax, it is also very appealing to employees. As you can see, Florida is home to more than already 125 publicly traded companies. Now, moving on. I would like to share with you the opinion of some current members of what it's like to be an RGIP member.
I came to Stetson University. One thing that I was really looking at was Roland George, and I've always wanted to get into Roland George, so being a part of it is something I feel very accomplished.
The RGIP class is not like a regular class. So from day one, you basically realize you deal with real money. In this case, you can actually use the knowledge that you gain from other classes.
One word, I would say Roland George is maybe rigorous.
Rigorous.
Rigorous. Real world. Enlightening.
Ambitious. Exhilarating.
And quite empowering.
Special, because you feel like you're part of something much bigger than yourself.
It's an environment where mistakes are allowed, where you can learn from them, and you get pushed to be the best version of yourself and learn to get out of your comfort zone and do great things.
Part of Roland George needs to be accountable because every decision that we make matters.
You need to be able to work well with others, take into consideration your professors and your classmates' ideas.
You need to have attention to detail. You need to be creative and collaborative, and then you also need to be able to question things that you do not know.
When I show it to my friends back home and all of this scenario and all that we do, they're so surprising.
It's the only class at Stetson that's offered real world experience that I feel prepares you for a job in finance.
It's different than any other class at Stetson because it gives you a very practical view of everything that you've learned up to this point.
RGIP.
That's why I joined the RGIP.
And that's why I joined the RGIP.
Alright, on tonight's agenda we have 6 presentations. I'll introduce each one of them prior to their start. Each year, the Roland George Investment Program fields a team to compete in the international CFA competition. This year, the CFA team will be presenting a debate type of presentation. Please help me welcome the CFA team.
welcome. In lieu of tonight's democratic debate, the CFA team has decided to present a debate of our own. Please help me welcome our analysts, Jimmy Dean and Chris DeGans. And I'm Zach Levesque. I will mediate the debate. Each year, the CFA Institute organizes a global research challenge where the regional charters choose a stock for their respective universities to research. To reach the objective, we will analyze the stock from both perspectives to make the best recommendation. And some of that process will be presented here today as we discuss Nextera Energy in the utility sector. Formerly known as FPL Group, Nextera Energy was founded in 1925 in Juno Beach, Florida. And through its subsidiaries, the company generates, transmits, distributes, and sells electric power to retail and wholesale customers in North America. The energy is derived from wind, solar, nuclear, and natural gas facilities. An innovative company with a market cap of $109 billion. Nextera is largest in the industry by market cap and sixth by revenue. To present the bull case for our debate is Jimmy, and Chris for the bear perspective. The outlook will have a 1-year horizon. Please direct your attention to the analyst consensus for Nextera for the next year. As you can see, 85% of analysts recommend a buy for the stock. 10% recommend a hold, and 5% recommending a sell, with an average target price of $239.09. The stock currently trades at around $234. Now, let's dive into the company with our analysts. Let's talk about Nextera's recent performance.
Nextera has had a strong year of 2019, posting extreme revenue growth for the past 2 quarters of 26.2% in quarter 2 and 22.3% in quarter 3. Their stock price as a whole is up nearly 33% year to date. A lot of this has to do with aggressive expansions and mergers and acquisitions. You're seeing a highly aggressive company that's focused on increasing their value through acquisitions as well as infrastructure improvements. I expect that this growth may taper off in the first half of 2020, but continue to be strong, especially when investors start to price in and realize their large-scale infrastructure projects.
I think the issue right here is that you are underestimating the short-term decline, consolidation within the company. Currently, the price to sales ratio is at 6.1. This is 3 times higher than the industry average, leading us to believe that it's trading at a relatively inflated premium. This, along with the upcoming earnings growth decline for Q4 of 2019 with a negative 1% growth year over year and a negative 15.5% growth for the first quarter of 2020 expected.
There's going to be growing pains as they complete these projects and as the pipeline gets complete, but you have to understand that just because they're going to experience a decline just because they experience a decline in earnings doesn't necessarily mean that their stock price is going to negatively be affected, especially at their long-term growth drivers.
Okay, thank you. So investors, of course, are always concerned with costs. What is there to be said about Nextera's cost?
This is key about Nextera Energy. They have a management team in operational expertise that is unmatched by their competitors. As we can see here, we're looking at the retail cost per megawatt hour. This is essentially how much it costs Nextera to bring energy to their customers. We're seeing that from 2018 to 2021, they're going to decrease the cost for their main utility, FPL, by 5%. And they're going to bring their recently acquired Gulf Power into line by reducing their operational costs by 50% when it comes to the retail cost per megawatt hour. When you combine this with the fact that they're improving service reliability for both companies, 5% for FP&L and 10% by Gulf Power, customers are going to very greatly appreciate the value that FPL is bringing them. And not only the customers will be benefiting from this value, but the shareholders will as well. They are finding ways that they can use their management team, their large-scale infrastructure, and their expertise to cut costs and improve their profit margins. This is how Nextera can control costs, and this separates them from their competitors not only in Florida, but nationally.
I believe that's a bit over-optimistic. We can look at some cost concerns here. There are diminishing infrastructure tax credits for the next years to come, decreasing to a 10% renewable infrastructure tax credit perpetually from year 2022 on. These tax credits are monumental for this industry. Many companies have flocked to quickly announce and to complete these wind and solar farms to take advantage of these tax credits. This also, with the increasing debt obligations, means that they're going through a period of consolidation to pay back these accumulated debts. They owe $11 billion within the next 3 years.
Listen, this debt is not a red flag. Investors should appreciate this. When you think of these large-scale projects that they need to expand their growth,
Final statements, please.
they can either finance this through debt, equity, or cash, obviously, right? They're giving their cash back to shareholders through their dividend growth, and they're taking advantage of these super low interest rates by managing this debt, especially when you combine the fact that they have a 4.1 debt to EBITDA ratio.
Jimmy, we need to move on.
This debt is easily coverable by their EBITDA.
Jimmy, thank you. So with the upcoming election coming forward, what kind of legislative risks are faced through NextEra?
NextEra faces 2 levels of risk. The first being state legislation. Currently on the ballot for November 2020 is the Florida Energy Choice Initiative Amendment. This does 5 things. It limits the activity of investor-owned electric utilities such as NextEra Energy. It provides a limitation of market power. It protects against deceptive or unfair practices. It prohibits any granting of monopolies and ensures the competitiveness of an open market.
NextEra can benefit from this.
This will be a negative thing for NextEra.
They're so competitively positioned.
Because of the high prices with Gulf Power. Gulf Power currently has the highest price for the top performers in the state of Florida.
They're reducing their operational cost effectiveness. They're improving their operational cost effectiveness.
They're improving it by switching from a mainly coal power generation to a natural gas powered generation. This is a very substantial cost for NextEra Energy. In fact, Tampa Electric Corp went through a very similar transition with half as much output being transferred, and it cost $900 million. $900 million that went directly to their consumer bills.
Gulf Power is not going to pass it to the consumers. You can see that FPL is already leading the industry in price. In a highly competitive market, more customers are going to flock to FPL, especially when you consider Gulf Power, the fact that not only are they increasing their cost effectiveness to the firm, they expect to reduce the regular residential bill to consumers by 20% by the mid-2020s.
Every company within the industry is looking to reduce the bills through the use of renewables.
They're looking
Duke
towards
Power, with it situated in Central Florida up into Tallahassee, will be the first responders to those customers who feel trapped in their Gulf Power energy bills.
Listen, NextEra has a track record of reducing costs for the customers and for the firm. This is only going to continue. You're going to see FPL and Gulf Power below the competitors.
Chris, you mentioned 2 levels of risk. Please elaborate further on the second.
Gladly. The second level of risk is a national level. As we know, we are in the middle of the Democratic primaries, and the 2 Democratic primary frontrunners are Elizabeth Warren and Joe Biden, both of which have a very strong environmental stance. This is with sponsorships of the Green New Deal and with interest of rejoining the Paris Climate Accord. The Green New Deal essentially establishes that we hope to become completely carbon neutral in the economy, not just in power generation, by 2030. The Paris Climate Accord takes it a step further with an international agreement to continue these strides on a global scale.
Listen, NextEra has publicly announced that they plan to be fully producing clean renewable energy by 2030.
This doesn't change the exposure that FPL, which is NextEra's highest revenue source, has 73.2% of their total power generation in natural gas.
There's 2 things to that. First of all their competitors do not have the long-term focus NextEra does. Whether or not this bill passes, NextEra is already making strides. They're prepared if this bill passes. Other companies are going to be rushing to improve their renewables. NextEra is already at that position. Secondly, NextEra is not the only company that's highly reliant on natural gas. All of their competitors rely on it more so, and they're already making the shift to a more renewable energy product.
If we look at NextEra entirely, they have nearly a 50% exposure to natural gas, and that is expected to increase as Gulf Power transfers from coal generation to natural gas.
Natural gas is cleaner than coal, and after this natural gas...
It's not emission-free.
It's not emission-free yet, but there's going to be a process. They can't snap their fingers and make everything emission-free. They're reducing their emissions while no other company can do so as much as they can because of NextEra's, not only their scale, but their expertise at finding innovative ways to bring clean renewable energy.
So I think we have a better understanding of how NextEra performs as a company. Let's dive a little bit deeper into the sector. Jimmy?
The utility sector promises, I believe, still plenty of growth. They've had a strong one-year performance, up nearly 42% on the year, compared to the rest of the S&P 500, up around 25%. There are several reasons for this, the first of which obviously being that utilities is a shield to volatility. When you think about a trade war, when you think about interest rate hikes, Brexit, etc., people are going to need utilities. You can lose your Disney Plus subscription. You can lose your Amazon Prime subscription. You can't lose your electricity. That's why people are investing in utilities. I believe that the strong growth will continue.
This has led to an over-evaluation of this sector. This sector, as he described, is a defensive sector. That does not mean it should be performing this well.
There may be a market correction
It cannot
eventually.
continue it.
It's not going to be
This is
anytime
due to
soon.
the volatility of 2019, and it's also due to the boom into renewable energy.
We're still experiencing concerns over an economic slowdown, meaning that investors are still going to be looking for defensive places to put their money. When you combine that with the fact that utilities benefits more from low interest rates compared to other companies, this sector is going to be very strong. When you think of another company that's taking out debt, utility companies need debt to fund these large-scale projects. And when debt is so cheap right now with these low interest rates, this growth is only going to continue. If these growth factors change, then yeah, maybe the utilities market correction will come. But we still have low interest rates, there's still plenty of volatility, and lastly, I mentioned the favorable regulatory environment. You just explained to me how that's going to continue with the Green New Deal. We're having so much more of a focus on renewable energy, and NextEra is the largest renewable energy provider.
Okay, Jimmy, so then please tell me, how does NextEra strategize within the industry?
Definitely. So we talked about FPL and Gulf Power. They're rate-regulated utilities that provide relatively stable cash flow to the firm. Now let's talk about their long-term growth drivers, which includes their aggressive growth strategy. They have announced that they plan to deploy $50 through $55 billion of capital through 2022. They're putting their money to good use, improving their infrastructure, sourcing out productive acquisitions targets, and improving their current power generation. Their M&A alone will increase their EPS by 15 cents in 2020 and 20 cents in 2021. They have the strongest position in renewables, as I mentioned, which is only going to become more
Renewables
differentiated.
is an industry-wide characteristic. You can't simply call that a unique characteristic as far as NextEra Energy, and the entire industry is pushing towards renewables.
That's true. The entire industry is pushing into renewables, but NextEra has been doing this for years. This is why they are the largest producer of renewables in the country. They're the largest renewable energy producing firm. That's why you stick with NextEra for this long-term growth. If you consider NextEra a country on its own, they would be the 7th highest renewable energy producing country in the world. We're talking countries here, not companies. How can you deny that this has a strong possibility for growth as our product mix changes to focus more on renewables? Nobody can catch up to them. They don't have the scale, the expertise.
We're running low on time here.
Essentially, when you're looking at how NextEra gains its money, you have those rate-regulated utilities, but this is why investors are eating up the stock. This is why they're trading at the ratios that you mentioned earlier that you believe are inflated. I believe that as larger projects continue to develop and finish throughout 2020 and onward, this stock price is only going to go up.
They're overreaching themselves. As we've already talked about their debt obligations, their current debt-to-equity ratio is 103.8%.
That's how they have to pay for these large-scale projects. They're using cheap debt right now. Why would you not be taking out debt in this low interest rate environment?
Okay, so where should we expect the strongest growth for NextEra moving forward?
The strongest growth is going to come from their unregulated energy production through wind and solar. As I mentioned, they're the largest wind and solar producer in America. Here we have a graph showing the current use of electricity in the United States on the inside. That was the 2018 usage. You see a heavy reliance on natural gas, coal, and nuclear, unrenewable energy sources, right? By 2030, we're expecting a shift to more renewable energy sources. And while NextEra already has the existing infrastructure for the wind and solar, as this demand for renewable energy grows, NextEra is already poised there. Companies are going to be scrambling to catch up, taking even larger debt obligations or financing through other means that have negative impacts for shareholders. That's why you pick NextEra, once again.
This is a long-term outlook, however. Many of NextEra Energy's subsidiary NextEra Energy Resource renewable projects are not set to be complete until after 2020. My colleague has mistakenly confused long-term growth with short-term potential.
Just because they're not going to be producing wattage within the same year, that doesn't mean investors aren't going to take that into effect when they're pricing out this stock. You're going to be seeing more announcements of large-scale energy infrastructure projects, which is only going to improve how the stock has been performing, not only against the market, but against utilities as a whole.
We cannot simply ignore the fact that NextEra Energy combined projected contracted renewable generation of wind and solar is only set to equate to 5.5 gigawatts of output after 2020.
So that's the current position right now. They're already taking efforts to expand upon this. That's why they have the large debt obligations that you mentioned earlier. That's why they're pursuing these acquisition targets, finding new and innovative ways, taking risks that their competitors wouldn't.
Please provide your closing remarks.
My closing remarks is that NextEra is unique in that it is a high growth company in a very defensive sector. This stock works for a growth portfolio as well as your defensive portfolios. They have the steadiness and the reliability of their rate regulated utilities combined with the extremely high growth in innovative renewable energy unit. When you put these two factors together, NextEra, I highly recommend you buy NextEra Energy.
I do not expect the short-term growth to continue at the pace that NextEra has established throughout 2019. For this reason and for the reasons I have laid out as far as political risk and debt obligations, I suggest you invest your money elsewhere and would recommend a sell for NextEra Energy.
Thank you, analysts, and thank you all for tuning in to tonight's debate. The upcoming election will play a key part for NextEra and the industry moving forward, so keep an eye out. I hope you gained a better understanding of NextEra within the industry, and wish us luck at the CFA competition. Thank you.
Our educational component of tonight's agenda is the step-by-step process that we follow when analyzing a company. The presenters are Rafael Northrop and Finn Busman.
Hello everybody, my name is Rafael Northrop and this is Finn Busman. Today we're going to be presenting on the Roland George Investment Way. By now you already probably have heard about the Roland George Investment Program at Stetson. The program focuses on investing in stocks and bonds throughout the year. This semester we learned how to appropriately evaluate and value companies that are publicly traded. The goal of this presentation is to provide you with an example of a full stock evaluation and the theories behind it. During the upcoming presentations, you realize that every stock analysis follows a similar pattern. The analyst takes the following factors into account: competitive position, financial performance, model parameters, growth drivers, the stock performance, valuation models, risks, critical metrics, and the price target and the recommendation of the stock. First of all, you need to check out the company's profile, which includes an overall company's description and its competitive positioning with the sector and industry it operates in. This includes essentials like the location, the management and management styles, as well as the size, in this case, the market cap of the firm. It is crucial to understand in what industry the company you're trying to evaluate operates. You also have to familiarize yourself with the sector and industry the company operates. On the one hand, there are sectors such as technology, which are considered to be cyclical. This means when the overall economy does well, stocks in this sector tend to perform well as well. They are therefore correlated with the market. Other sectors, like consumer staples, are non-cyclical. So, in this case, these sectors are especially interesting in economic downturns, since stocks in this sector won't be affected as much as cyclical companies. We're trying to identify if these sectors are high growth sectors that are affected more by events like the trade war, an upcoming recession, or an election.
In order to illustrate Rafa's theoretical part, we're going to use L3Harris Technologies as an example throughout this presentation. L3Harris Technologies was founded in 1895 and it's headquartered in Melbourne, Florida. The company was formerly known as Harris Corporation, as we invested originally in.
However, in June 2019, the company finalized its merger with L3 Technologies. As a result of that, the company now operates under the name L3 Harris Technologies. Despite this change, the management of the company remains stable, as the CEO, William Brown, will continue his functions. The company's current market cap is at $46.5 billion. L3 Harris Technologies operates within the industrial sector, a rather cyclical sector, and to be more specific, in the aerospace and defense industry. They provide technology-based solutions that solve government and commercial customers' mission-critical challenges in the United States and internationally.
The segment performance describes the components of a business that generates its own revenues and creates its own product and product lines. Segments typically have their own discrete associated costs and operations. Since the segment performance gives you a good understanding about the revenue sources of the company, it can also divide growth drivers into different categories. Furthermore, the segment performance analyzes the customer profile. This represents the target market the company focuses on.
As Rafa mentioned, it is crucial to identify the revenue streams of a company. L3 Harris Technologies operations can be divided into three sectors: electronic systems, communication systems, and space and intelligence systems. They account for 38, 32, and 30% of the total revenue respectively. Electronic systems provide electronic warfare, avionics, and solutions for defense operations, as well as civil and military aviation. Communication systems serve the market in tactical communication and defense products. Space and intelligence systems provides intelligence, space protection, complete Earth observation, and environmental solutions. Secondly, it is valuable to look at the customer's profile. Unlike traditional defense companies, L3 Harris Technologies has a unique dual business model, which allows them to capture market share from both government-funded and commercial markets. However, looking at the pie chart, you will notice that approximately 87% of the contracts are made with government entities. In contrast to that, only 13% are made with the commercial market. It is important to note, however, that the commercial segment has a significantly higher gross margin than the government contract of the segment. Even though this market cannot replace the sales from government contracts entirely, it can effectively hedge some of the losses from low government contract periods.
The Roland George Investment Program has the mission to invest specifically in growth stocks that are supposed to not only show a positive return during the next 12 months, but also to beat our selected benchmark. In finance, a benchmark is a standard against which the performance of a security can be measured. Generally, market indices that represent a pool of stocks are used for this purpose. The Russell 3000 Growth Index was used during the semester as a standard against a stock and the overall portfolio performance. Alternatively, we compare stock performances to the company's closest competitors that, for instance, offer similar services or products, are similar in size, and operate in the same industry. The price performance of the stock is highly correlated to external and internal events that affect the individual success of the company. Historical events and the past performance can indicate future risks and threats, but also opportunities the company might pursue in the future. This is clearly not a guarantee for future results, but gives you a good understanding of how volatile a firm reacts to different situations.
Now we would like to highlight some of the events that have affected the company's share price during the last 12 months. The graph compares L3 Harris's performance with the Russell 3000 Growth. Area A shows the effect of an announcement made by the government. The White House signaled that the remarkable surge in defense spending could potentially be over. Multiple defense companies, including L3 Harris, fell due to the uncertainty of the upcoming budget proposal. The two areas marked with B show 2 times where L3 Harris was able to beat and in some cases meet analyst expectations. Going into the year 2019 and midway through it, they were able to report strong numbers, which led to an overall positive outlook. Next, in February, shown as Area C, the aerospace and defense industry, including L3 Harris, experienced prices to stagnate or decline. This was due to an announcement of a potential merger between United Tech and Raytheon, two former competitors. Lastly, Area D shows the effects of a successful merger between Harris Corporation and L3 Technologies, which was finalized on June 29.
Diving into the financial analysis, you need to analyze the historical financial performance and come up with a forecast of the forward-looking financials. However, financial statement forecasts need to be treated with caution, since minor differences could lead to major changes in the forecasted fair value of our company. Revenue, dividends, free cash flow, earnings, and other multiples, such as price to earnings or price to sales ratio, are the key measures to look at when performing a financial analysis. There are also different characteristics of the stock you have to pay closer attention to. The beta is defined as the sensitivity of an asset's return relative to the return on the market index. A beta of 1 indicates that when a market index rises by 2%, the analyzed stock rises by 2% as well. The stock has a close correlation to the market index. A stock responds more aggressively on economic events when it has a beta higher than 1. While a beta lower than 1 indicates that the company will not be affected by as much as the market index in economic downturns or upturns. This can be an opportunity for investors to take on more or less systematic risk when investing in stocks. The required market risk premium is the rate an investor requires to compensate for the risk and opportunity cost when investing in the equity market. This can be derived from using either historical values or forward-looking assumptions. The weighted average cost of capital represents an estimate of the overall cost of capital to fund the company. It is the overall required rate of return that must be generated in order to satisfy the costs for equity and debt. The implied alpha is the expected excess return from a stock to justify its current weight in our portfolio. As mentioned earlier, all assets need to satisfy the basic trade-off between risk and return. If you expect the asset to overperform our benchmark more than the implied alpha, then the asset meets the trade-off. Therefore, if an implied alpha is negative, the stock could even underperform the benchmark and could still add value to our portfolio.
As you can see on the chart presented on the slide, the revenue displayed as a gray shaded area behind the bars was fairly steady with only small growth from 2016 to 2019. However, L3 Harris is predicted to have a sharp increase in 2020's revenue. This high revenue growth is a result of this year's merger. After that, estimates show a sustainable revenue growth for the next couple of years. Further, notice the stable increases in dividends and earnings per share. Despite a little drop from 2016 to 2017, earnings growth was continuously growing positively. In addition, forward dividends have grown on a low but consistent basis. The lower increases in dividends likely indicate an upcoming increase in dividend amount.
Stock prices are determined in a marketplace where seller supply meets buyer demand. However, there's no such formula that tells us exactly how the stock price will behave. That being said, we do know a few things about different forces that move a stock up or down. These forces fall into 3 categories: fundamental factors, technical factors, and the market sentiment. In an efficient market, stock prices would be determined primarily by fundamentals like a company's earnings base, a revenue growth, or any other valuation multiples such as price to earnings ratio, just to give you an indicator. When you buy a stock, you're purchasing a proportional share of an entire future stream of earnings. That's the reason for the valuation multiple. It is the price you're willing to pay for the future stream of earnings. Technical factors are external conditions that influence the supply of and the demand for a certain stock. Some of these indirectly affect the fundamentals. Technical factors include inflation, the economic strength of the market and the industry the company operates in, substitutes such as the competition, incidental transaction, which includes insider transactions, as well as certain short-term trends like momentum or even the liquidity of the stock. Market sentiment refers to the psychology of market participants. This is perhaps the most vexing category. Market sentiment is often subjective, biased, and obstinate. For example, you can make a solid judgment about a stock's future growth prospects, and the future may even confirm your projections, but in the meantime, the market may myopically dwell on a single piece of news that keeps the stock artificially high or low, and you can sometimes wait a long time in the hope that other investors will notice the fundamentals. However, since the RGIP is mostly interested in the actual fair value of the company during the next 12 months, we keep our focus mainly on technical and fundamental factors.
Throughout our research, we have identified 4 primary growth drivers: industry performance, consistent earnings, competitive position, and continuous growth in contracts. Firstly, industry performance. Aerospace and defense companies have been outperforming the Russell 3000. With increasing political pressure, the United States defense budget has been steadily increasing, leading to a better overall performance for the defense industry. The 2019 budget was an 18% increase compared to the 2018 budget. The budget is predicted to even further increase from $689 billion to almost $750 billion in 2020. This would create optimal conditions for L3Harris to further grow. Another growth driver is the company's consistent earnings. L3Harris was able to maintain consistent earnings over the last 4 years. As presented on the slide, the company was able to match or exceed expectations for most of the quarters from 2016 to 2019. This has led to steady growth in the company's share price. Thirdly, the improved competitive position will help the company to further grow. After the merger in 2019, L3Harris became the 5th largest defense company in the United States and ranks amongst the top 10 defense companies globally. L3Harris benefits from its increased scale, a well-balanced portfolio of complementary franchises, a shared culture of innovation and operating philosophy, which creates a stronger platform to drive growth, a meaningful value creation opportunity, and a strong balance sheet with significant cash flow generation. The two companies have been on similar growth trajectories, and combining will accelerate their growth at a much faster pace than either of the companies could alone. Lastly, in 2019, L3Harris was able to acquire new and extend old contracts. In May, the company added a 3-year, $284 billion sole source extension contract on their contract with National Oceanic and Atmosphere Administration. L3Harris will deliver new technologies that support increased capabilities. 1 month later, L3Harris received a $51 million foreign military delivery order. The company will provide modern narrowband radios and wideband radios, which will help increase the interoperability between the US and other NATO forces. Lastly, in August, L3Harris got an extension on their $2 billion partnership with the US Navy. This was the largest order on the program to date. The company will manufacture and deliver integrated defense electronic countermeasure jammers. The deliveries are expected to be completed by August 2022.
Risk analysis is the process of assessing the likelihood of an adverse event. An adverse event is a change in circumstances that significantly reduces the value of a company. Political, economic, operational, environmental, and social cultural risks have a negative impact on the stock. Political factors relate to how the government intervenes in the economy. Specifically, political factors have areas including tax policy, labor law, environmental law, trade restrictions, tariffs, and political stability. Economic factors include economic growth, exchange rates, inflation rates, and interest rates. These factors greatly affect how businesses operate and make decisions. Operational risk summarizes the uncertainties and hazards a company faces when it attempts to do its day-to-day business activities within a given field or industry. Environmental factors include ecological and environmental aspects such as weather, climate, and climate change, which may especially affect industries such as tourism, farming, and insurance. Lastly, social cultural factors include the cultural aspects and health consciousness, population growth rate, age distribution, career attitudes, and emphasis on safety. High trends in social factors affect the demand for a company's product and how the company operates. That being said, we must identify those risks in order to know what could go wrong and what the potential threats the company might be facing could be.
There are 3 risks associated with the operations of L3 Harris: supply chain risk, political risk, and deleveraging risk. Firstly, the defense industry has become too reliant on outsourcing technology. Much of the work on defense contracts is currently done by subcontractors. Many of the larger defense companies rely on defense contractors that overlap across the board, which can create a supply chain disruption risk. This potentially could create a house of cards type scenario, where failure with one company could have an effect on many other supply chains. Secondly, upcoming political changes could potentially have a negative effect on L3 Harris. Since being elected, President Trump has been consistently increasing the military budget. There's a risk, however, that this does not last moving forward. The graph shows a close correlation between the US military budget and the company's stock performance over the last 5 years. Therefore, the upcoming election can be seen as a risk factor. Lastly, in 2015, the company acquired a former competitor, Excelis. Purchasing Excelis for around $4.6 billion required the company to take on almost $3 billion on debt. If L3 Harris were unable to follow the payback schedule, they would have to increase their leverage again, which could potentially put the company at a risk of default.
There are different valuation models that can be used to find out about the fair value of the company. There's no one method that's best suited for every situation, since each stock is different and each industry or sector has unique characteristics that may require different valuation methods. Absolute valuation models attempt to find the intrinsic or true value of an investment based on only fundamentals. Looking at fundamentals simply means you would only focus on such things as dividends, cash flow, and the growth rate for a single company, and not worry about any other companies. Further, we use relative valuation models in order to compare fundamentals such as sales per share, earnings per share, and other multiples relative to close competitors, market indices, or other industry averages the company operates. We're trying to forecast the fair value of the company during the next 12 months from today. In order to know what absolute and relative valuation model is appropriate, we use a valuation that is based on the main growth drivers of the company that we were able to find earlier in our segment performance analysis. Further, we forecast the variables including a sustainable growth rate and fundamental factors necessary for our valuation method. The fair value of the company will then show if the company we analyze is currently under or overvalued, and if a potential investment in the company would currently make sense.
For our valuation, we used some of the key measures that we found in our financial analysis and used them as inputs. The beta is currently at 0.75, which is lower than 1, meaning that it's a little bit less volatile than the market. The expected return of the market is at 9.35%. With the risk-free rate of 1.75%, we calculated the market risk premium to be at 7.6%. Using these numbers, we found the CAP-M to be 7.4%, which equals our required rate of return in our upcoming valuation. After reviewing the company's growth drivers and key measures, we decided to use the Malkiel's model. For this valuation, we chose 6, 7, and 8% growth rates, as we wanted to present you with numbers for a pessimistic, expected, and optimistic scenario. We found the current fair value of L3 Harris Technologies to be in the range of $229 to $242. This implies that the stock is currently undervalued by 13% to 20% at a current price of $202. We chose to use Malkiel's model for our valuation because it suits companies that are expected to have accelerated near-term growth and the differential long and short-term growth. Our assumption that L3 Harris is going to experience great growth in the near future is primarily based on 2 factors: the continuous growth in contracts and the merger of this year. Further, the model is appropriate because L3 Harris has stable dividends with positive growth, and it's nearing the firm's maturity. Our personal price estimate range seems rather conservative when comparing it to the analyst estimates. Analysts expect a 12-month price target range of $219 to $270, with the consensus being at $247. Our relative valuation showed that compared to the company's historical data of the last 3 years, the EV to EBITDA multiple that we calculated to be around 17 seems rather expensive. This, however, is reasonable due to their expected growth in the near future. Further, we compared L3 Harris's EV to EBITDA multiple to the industry. The ratio is positioned more towards the lower end, indicating a price advantage over competitors and a good investment opportunity.
After your due diligence and the resulting intrinsic valuation of the company, you can finally make a decision about whether to recommend buying the company or not buying it. If the stock is overvalued compared to your fair value, you would not recommend buying it. However, if the current stock price of the analyzed stock is lower than the calculated fair value of it, the forecasted return of the stock beats our benchmark and meets the trade-off between risk and return, you can finally recommend to buy shares from the company. This final recommendation should take as much information into account as possible.
Concluding, we recommend holding, and if we were not holding it yet, buying L3 Harris Technologies due to its defense industry performance, its consistent earnings, continuous growth in contracts, segment performance, and overall competitive positioning. Based on our analysis and valuation, L3 Harris Technologies is currently undervalued by 13 to 20% at a price target range of $229 to $242. Consequently, it will continue to be beneficial to the RGIP growth portfolio. Thank you. Chris, yeah, first question.
Great presentation, guys. First off, Joe Biden is currently the leading frontrunner in the Democratic primaries. I know you mentioned political risk. However, could you elaborate on Joe Biden's defense policy and what that means for L3 Harris?
Yes, definitely. Thank you for asking that question. It's a valid concern because I showed the correlation between the military budget and the stock's performance. However, I read a couple of statements from Joe Biden, and he actually said that he would like to boost the defense budget in some key areas that have high priorities for him. And this could actually help L3 Harris to grow even further in the future. However, there's always some degree of uncertainty towards whether if he gets elected or not, or if he actually makes these changes when he gets elected.
Hi, I have a question for you guys. I've read that L3 Harris could be exploring divestitures after their merger early in the year, and for reasons including antitrust lawsuits, as well as reasons to eliminate overlap. How do you think that these divestitures will affect stock price, and what should investors be looking for when these divestitures are announced?
Thank you, Jimmy. Interesting question. I would like to answer that question on two sides, internationally and nationally. First of all, the EU Commission actually approved L3 Harris's merger according to the merger regulations they have. However, in order to comply with the regulations, they have to divest part of their business. And it's a similar situation in the United States as well. However, I read a couple of statements of the company, and they said that they will be divesting their business, but will be still focusing on a product mix that will increase their competitive advantage and cost synergies. So with the information I have available right now, I think it will actually help the company to further grow.
Great, thank you.
Thank you.
Next, we have Spectrum Brand. The company CEO is a Stetson alumni. When analyzing a company you're personally connected to, you might be influenced by personal emotional biases. To reduce this risk, we had two analysts take opposing viewpoints. Please help me welcome our analysts, Tiffany Cranston and Alyssa Tripodi.
Good evening, everyone. everyone. My name is Tiffany Cranston.
And I'm Melissa Ducote.
And we will be presenting a analyst recommendation on Spectrum brands. So in this presentation, we will be following the typical RGIP way, starting with the competitive position of the stock, and then ending with the price target and recommendation for it.
So what is Spectrum Brands? Spectrum Brands is a Fortune 500 company. They're a member of the Russell 1000 Index and a leading supplier of residential lock sets, specialty pet supplies, lawn and garden, and pest control products. Based in Middleton, Wisconsin, Spectrum brand products are sold by top 25 retailers and are available in more than 1 million stores in 160 countries. Some key factors to look into are the CAPM of 9.8% and the 52-week price range of $41 to $65. The year-to-date return is 46.55%. The trading price today is $62.42.
So getting into their 4 business units, they have hardware and home improvement, global pet care, home and garden, and home and personal care. Their hardware and home improvement category includes products and lock sets, builder's hardware, and plumbing. Their leading brands are Kwikset, Baldwin, and Pfister. Their global pet supplies unit is a leading worldwide supplier of pet products for dogs, cats, birds, small fish, and other small animals. Their leading brands in this unit include Healthy Hide, Dreambone, and Nature's Miracle. Their home and garden unit has lawn and garden products, as well as interior and insecticides. Their major brands include Spectracide, Liquid Fence, and Hot Shot. Lastly, their home and personal care unit boasts products from juicers and tea kettles to electric shavers and hair straighteners. Some notable brands in this category include leading hair care brand Remington, as seen on TV brand George Foreman, and popular small appliance brand Black & Decker.
Now we'll get into the current versus historical sales by segment. As you can see, the moneymaker for this company is HHI at 36%, with close seconds of HPC and PED of 28% and 22%.
So Spectrum Brands has 3 key growth drivers that will drive them into the future, including accelerating e-commerce sales, their global productivity improvement plan, and their capital allocation plan. Spectrum Brands is utilizing data-driven digital marketing and internet advertising to boost their e-commerce presence. In an effort to increase their efficiencies and maximize their profits, Spectrum Brands is reprioritizing their capital allocation. In Q2 2019, Spectrum Brands repurchased $250 million worth of their shares, with up to $750 million remaining on an existing 3-year buyback plan. This means that Spectrum Brands believes in the future of their company. Lastly, Spectrum Brands' Global Productivity Improvement Plan is a 6-step plan that will improve their total annualized operating costs by at least $100 million in the next 18 to 24 months. Their main goals within this plan include strategic sourcing in all their business units and utilizing best practice implementation and automation across finance, human resources, and other back-end services.
When analyzing Spectrum Brands, there are 4 investment risks to look out for: the slowing revenue growth, the fact that Spectrum Brands is a sector outlier in the consumer staples sector, the underperformance in all business units, and the alleged class action lawsuit. The slow revenue growth is due to the net sales of $875 million in Q1 of fiscal 2019, which decreased 4.9% compared to $920 million last year. This is excluding the impact of $13.6 million of unfavorable foreign exchange, organic net sales of $882 million, which also fell 3.4% versus the prior year. Net loss from continuing operations of $30 million and diluted loss per share from continuing operations of 56 cents in Q1 of fiscal 2019 is to be compared to the net income from continuing operations of $40 million and diluted income per share from continuing operations of $1.24 in the prior year, primarily due to the recapture of $29 million of non-cash depreciation and amortization charges for the HPC unit. This had been not recorded last year due to the segment being classified as held for sale. Next is the sector outlier. Spectrum Brands does not perform like the average consumer staples sector. Fundamentally, consumer staples stocks diversify a risky portfolio. The lack of financial stability profitability leaves it to be a much riskier stock compared to the average consumer staples company. Spectrum Brands has a beta of 1.168. This is to be compared to the consumer staples beta of 0.72. This means the Spectrum Brands stock price moves with the market much more than the consumer staples sector. Moving on to the underperformance of all business units. Hardware and home improvement is Spectrum's largest revenue driver at 35%, with an adjusted EBITDA of 44% for the year. Spectrum Brands saw lower growth than forecasted, with year-to-date organic revenue and adjusted EBITDA reported down 2%. As Spectrum Brands is headed for a 3-year CAGR of 1%, this is due to the year-to-date trends. Operational expenses and internal efficiencies drove a weak Q3 2019, with organic sales suffering 4.3%. The global pet supplies industry unit drives 22 to 23% of revenue and about a quarter of earnings, but reported lower than expected revenue. Organic sales from 2017 to 2019 declined 13%. The profitability remains an issue, with adjusted EBITDA down 3.5% in 2019 from reduced production. The home and garden unit had multiple downward trends reported, starting with lower than expected revenue, reduced production from unfavorable manufacturing variances, and an early retail shutdown of the season. Spectrum Brands continues to struggle to stabilize the H&G unit. The absence of hurricane-driven demand for insecticides and repellents caused the segment to plummet 19% in 2018, a third year of low returns. Lastly, the home and personal care unit consists of 28% of Spectrum Brands' net sales. In the past quarter, Q3 2019, this unit's reported net sales fell 4.3%. This was due to a foreign exchange cost of $10.3 million. While net sales saw an increase in Europe, net sales for small appliances decreased from the prior year due to lost distribution in the US for mass channel in coffee makers and toaster ovens. Also, personal care sales fell in the US, with Spectrum Brands attributing the decline to prior year hair care distribution losses. Moving on to the alleged class action lawsuit. Shareholder rights law firm Roland Arroyo announced purchases of Spectrum Brands filed a class action lawsuit alleging violations of the Securities Exchange Act of 1934 between 2016 and 2018. Spectrum Brands assured investors of its progress with its improvement initiatives, which included the development of its Ohio and Kansas facilities since 2017. They told investors the distribution centers were on track to help reduce expenses in inventory, but Spectrum Brands failed to mention the self-inflicting, recurring operational issues in those facilities. The previous CEO, Andreas Rove, repeatedly downplayed the glitches regarding the construction and operation of the distribution centers. When the truth was released on April of 2018 during a conference call with the now new CEO and Stetson alumni, David Mora, admitted to long-term problems with the facilities and the prolonged recovery period. After this news was released, the stock plummeted 20% to close at $75 on April 26 of 2018. Since then, the stock has been on the downfall, trading significantly below the stock's class period high. Today, it is trading at $62.42.
So regarding Spectrum Brands' financial performance, they have definitely seen volatile numbers within some. In Q4 2019, Spectrum Brands saw a 26% revenue growth year over year from Q4 2018. This sharply contrasts Q3 2019's negative 0.7% growth from Q3 2018. Due to this volatility, it is expected to see future revenue growth within the low single digits. Spectrum Brands' EPS has not beaten estimates until Q3 2019. However, this is nothing to be alarmed of. The lower EPS can be attributed to Spectrum Brands' large amount of R&D that drives down this number. However, the turnaround in their EPS in the past 2 quarters exemplifies improvement in Spectrum Brands' financials.
Now we'll get into the critical events and the year-to-date stock performance. I will touch on 5 different points. The dip in February is due to the first quarter net sales missed. Spectrum Brands recorded net sales for Q1 of 2019 at $875 million, missing the lowest estimate of $911 million. The company's gross margin grew by 35%, with adjusted loss per share from continuing operations predominantly due to the one-time recapture of $25 million or 41 cents a share. Point B, was the dip in June. This was due to trade war and federal interest rates. The United States escalated the trade war with China when they hiked tariffs on $200 billion worth of Chinese exports hours after the trade talks were held. Tariffs on the targeted exports increased from 10 to 25%, significantly affecting the consumer staple stock and the Russell 3000. Point C. Late August to beginning of September was the announcement of the credit agreement. Spectrum Brands Holding announced that its subsidiary, Spectrum Brands, had completed the prepayment in full of its term loans totaling $1.2 billion from cash proceeds received on January 2nd of 2018 from the closing of the divestiture of its global battery and lighting business. This is an important step, beginning the process of materially improving and strengthening our capital structure in fiscal 2019. Moving on to point D, was a dip in October due to Jefferies Financial, or Jeff, distributing Spectrum Brands stock. Jefferies Financial Group, which currently owns 7.5 million shares, or 15.4% of Spectrum's common stock, announced that its board of directors have approved to distribute to stockholders of Jeff of these Spectrum Brands shares. This dividend took effect on October 11th of 2019. Stockholders of Jeff will receive a quarter of a share of Spectrum Brands common stock for each share of Jeff common stock owned. Based on closing market information, the dividend reflects a distribution of $1.50, or 7.4% per Jeff share. Lastly, E, the most recent stock performance, is the increase in November due to Q4 earnings surpassing estimates. With a reported $1.13 per share, they beat estimated earnings of $1.09 per share. This is compared to 79 cents per share a year ago. Moving on to key measures, we looked into free cash flow, gross profit margin, and PEG. Free cash flow completed Q4 with a strong liquidity position, including $779 million available of our $800 million cash flow revolver and a cash balance of $627 million. Our adjusted free cash flow from continuing operations is expected to be between $240 and $260 million. Our gross profit margin is one of Spectrum Brands' stronger financial attributes. In Q3 of 2019, Spectrum Brands' profit margin was 35%. However, this is lower than Q2's 2019's profit margin of 2%. In Spectrum Brands' Q3 report, they state the positive pricing and profitability were partially offset by input cost inflation, tariffs, and unfavorable product mix. Lastly, Spectrum Brands has a PEG of 3.2 compared to the consumer staples PEG of 2.44. A low PEG can be from a low PE ratio. You want to pay less for your growth. However, Spectrum Brands does not have as much implied growth as it has not responded that much to the consumer staples sector. A low PEG implies growth. However, higher the growth, the lower the PEG. That is why it doesn't match the consumer staples sector. As the PE ratio is down, we're paying less for our earnings. In other terms, the price has gone down relative to their value. Looking into analysts' recommendation, we had a target price of high of 77 and a low of 53. On Bloomberg, there were 7 analysts covering the stock, with buy versus hold ratings of 57.1% versus 42.1% respectively.
Looking at the relative valuations, you can see that Spectrum Brands is trading either at or towards the lowest multiple in comparison to other stocks in the same sector. This already shows that this stock is undervalued. If the stock were to trade a little bit higher, the stock price would definitely explode. So for our critical assumptions, Spectrum Brands expects net sales growth of low single digits. So we are using 3 conservative growth rates for our valuation: a pessimistic growth rate of 2.5%, an expected growth rate at 3.5%, and an optimistic growth rate at 4.3%. For our capital structure assumptions, we expect to see an increase in mergers and acquisitions within the next year due to the $620 million of cash in their balance sheet. With an expected free cash flow of $317 million in 2020, we are going to use a conservative $250 million in our valuation. And despite a decrease in capital expenditures in 2019, we expect to see an increase of 17% in 2020. So moving on to the free cash flow model. This model was chosen because of Spectrum Brands' positive free cash flow and because Spectrum Brands is a diversified and matured company. By skewing our three scenarios, 60% pessimistic, 30% expected, and 10% optimistic, we found a share of $97.64, meaning our stock is undervalued by 58%.
With all this being said, Spectrum Brands has seen volatile times. This company is making wise investments to secure a positive future for itself. By being beaten down is the perfect opportunity to buy. The growth drivers previously mentioned show success already in Q4 2019's earnings report. With all of this being said, we recommend the RGIP to buy 1,000 shares of Spectrum Brands. Thank you. Questions? Peter?
Great presentation. IoT is a new frontier for home improvement and appliances, and it's expected to double by 2021. 5 out of 7 brands in your most lucrative segment, hardware and home improvement, specialize in doorknobs and locks. What is Spectrum's plan for competing with tech giants like Amazon, Samsung, and Google, considering all three have smart locks, and Amazon offers small appliances that are Alexa enabled, such as microwaves and slow cookers?
Great question. So Spectrum Brands is kind of in a good position when it comes to smart technologies. Their Lockset brand Quickset is actually one of the 3 partners for Amazon's Home Key technology. So that's good. And then regarding appliances, smart appliances, Black & Decker is more towards the low-end segment. So I don't see them trying to penetrate the smart technologies at all in the future.
Thank you.
Any other questions?
I have a question. Sorry. Spectrum performed well last week, beating sales expectations, EPS expectations, and reducing their leverage. However, as this net loss increases, what steps are being taken to correct and improve internal business processes to deliver stronger profits?
Thank you for your question. They're enhancing their internal capabilities by using strategies such as increasing their dedicated staff, and expanding tool sets and cross-divisional cooperation. So they're streamlining a lot of their back-end services to cut costs and increase profits.
Thank you.
If I could take us back to the section regarding legal risk.
Yes.
Are any of your research shows that any of the home products have any cancer-causing chemicals?
Any of our home products?
I do not know that answer as of right now. However, I am aware that usually when these types of products do have cancer-causing chemicals, they will have a caution label to keep your mouth, eyes, face away from it when spraying, and to use a cover just in case.
Thank you.
Any other questions? Thank you.
Our next presentation is going to showcase one of the fastest growing companies in Florida. It's presented by our analyst, Quentin Berghammer.
Hello everyone, my name is Quentin Berghammer, and today I'll be presenting to you a company within the construction and building products industry, my company, TopBuild. TopBuild is headquartered down the street from us, located in Daytona Beach, Florida. TopBuild's ticker is BLD. Now before we're going into further detail on this stock, I want to take you on a little road trip on what we will be covering today. We will first be looking at their competitive position, and then we'll be ending on my price target and my recommendation. So for competitive profile of TopBuild, expansion has allowed TopBuild to become the industry leader for installation and distribution of insulation. This has been attributed to 2 of their subsidiaries, including TrueTeam, which makes up insulation, 67% of the company, with over 190 branches located nationwide, as well as Service Partners, which is in charge of distribution, making up 33% of the company and having 80 locations nationwide. TopBuild has 102% stock growth over a 1-year period so far. And illustrated on the map, we can see the various locations they are present nationwide. Looking at revenue by segment. 71% of revenue by segment is made up of insulation, while 29% is attributed to remodeling, including products such as roofing, rain gutters, fireplaces, and closet shelving. With revenue by segment, residential makes up 80%, while commercial makes up 20%. Growth factors. Why would we want to invest in Top Build? These are the main facets to really recognize. The main one would be their expansion plan. Top Build plans to expand both True Team and service partners into the top 25 metropolitan areas located nationwide. They want to get into commercial businesses as well as homeowners within these locations. They also like to acquire acquisitions. They have 4 as of now, including USI, ADO Products, Viking Insulation, and Santa Rosa. This happened between the time period of the end of 2017 going into the beginning of 2019. Now, before USI was acquired, in 2017, they reported $375 in annual revenue, which is a huge increase for Top Build. CEO expertise. The CEO of Top Build is Jeffrey Volas, who has 32 years of experience within the building product sector. Jeffrey Volas has increased their profit margins each and every year since 2015 when they IPO'd. Now, recession protection. As many know, during a recession, your housing prices will devalue in price, causing many to have to sit on their houses at that point in time. By having to stay in the houses that they are located in, they may want to invest in remodeling, including some of the products that Top Build offers, allowing revenue streams to continue. Also, no matter what time in the economy, you will have to repair your roof gutters, your roofing, as well as insulation. With financial excellence, revenue growth rate is at a 16.39% for Top Build, as well as they have reached and met expectations for each earnings throughout 2019, which is very impressive. I will go into their financials in later slides. For risks, market cyclical. The construction industry is cyclical, meaning it moves with the economy. The company relies close to 80% of its business on residential homes. While consumers are looking to save money during this period, less construction activity will occur, decreasing demand for insulation within these households, which could negatively affect Top Build. Dependent on third-party suppliers. The company's main supply is then called fiberglass insulation. Fiberglass has historically experienced times of shortages as well as oversupplies during past housing market cycles. During recessions, the supply prices may be more volatile, which could adversely affect Top Build. Looking at sales force retention, within the sector, there has been a labor shortage of high caliber sales personnel. While Top Build plans to expand their business and get a more of a national presence, this could hurt them with retaining those high caliber sales representatives. Now, seasonality. Construction activities mainly occur in Q2 and Q3 of the fiscal year. In Q4, this is when weather conditions may come into effect with snow, allowing construction activity to decrease. As we see represented in the chart, through 2017 through 2019, Q2 and Q3 have increased while Q4 has decreased. Financial performance. What should we look at when we're looking at BLD's financial performance? We look at their revenue, their net income, and their gross margin. Revenue hiked in 2018 over 25% in growth year over year, which this happened because of the acquisitions that they made, the 4 companies I previously mentioned. Their net income gross rate is at 6.62%, while their gross margin is at over 8%. These are impressive numbers. Critical events. When comparing Top Build to Roland George's benchmark, the Russell 3000, we see that their stock price has elevated and has been on a momentum path throughout the year. They have grown over 100%, which is impressive. However, there were 2 points where there were downward trends. In point A, we see warning signs within the sector, causing a slow sell-off, lowering the stock 3%. In point B, the trade war escalations happened with a rise in tariffs. There was a scare over consumer spending. With less spending, less insulation is needed. Now in point C, BLD boosted their adjusted EBITDA forecast from $345 million to $355 million, as well as adjusting their revenues from $2.64 billion to $2.67 billion, showing investors this was the time to buy. And point D, TopBuild beat earnings estimates for the third consecutive time. This allowed investors to also see a hike in the price of TopBuild. Financials versus competitors. TopBuild's main competitors are Home Depot and Installed Building Products. While Home Depot is a large cap stock, we see TopBuild and Installed Building Products being small cap. However, when they acquired those companies, their EPS surged above Home Depot for their earnings per share. And for return on assets, their return on assets have been over competitors since Q3 of 2017, which is very impressive. Critical assumptions. For growth, I see revenue growth rate surging above 16%, EPS growth at 19%, as well as their profit growth at 7%. Their capital structure is very different compared to a lot of companies. TopBuild does not like to acquire a lot of debt. Instead, they rather have enough cash on hand in order to acquire new companies and expand. Their financial leverage is at 2%, matching the industry's average, as well as their free cash flow growth rate surging past 37%. This is a very important number to analyze. Horizon. They plan to expand their branches, as well with TopBuild, with True Team and Service Partners, and acquire more companies going into 2020. Capital costs, I calculated the WACC at 6%, while they cap them at 9% leading into my valuations. For my valuations, I used the implied PE and the free cash flow model. For implied PE, I saw that the TopBuild was undervalued by 19% and free cash flow approximately by 16%, giving this stock an average fair value of $126. Their current price as of today is at about $110. And looking at a pessimistic and optimistic outlook, I see the stock still rising, undervalued 12% for pessimistic, while for optimistic, I can see the stock surging above $130 per share. Analyst recommendations in the field. Looking at analyst recommendations, the target price was at $116, the mode $120, and the range from high-low $105 to $120. There were 8 analysts that covered BLD stock, 5 recommended a buy, while 3 recommended a hold. Other valuations that I used, I looked at their PE. The important thing to point out here is their PE is on the lower end, showing that this stock may still be undervalued and can grow, leading into my buy recommendation. Due to TopBuild shares being undervalued by 18%, along with strong revenues, sustainable growth, and being the leader in insulation and distribution industry, I recommend the Roland George Investments Program buy 550 shares. Any questions? Peter.
Outstanding presentation.
Thank you.
So, because public companies post supply and house building materials, do they benefit from natural disasters?
Great question. So yes, TopBuild does benefit from disasters. Unfortunately, when houses are ruined, they're going to need to have insulation and all those repairs. So TopBuild will grow with revenue. However, a lot of their manufacturing and distributions are located in Florida, and because of hurricane seasons, those could be damaged, hurting their inventory. So it's a balance, but overall, TopBuild usually benefits.
Great, thank you.
Thank you. Jimmy.
So, TopBuild has seen very strong growth over the past year and a lot of momentum, even in the face of talks of an economic slowdown. So my question is how they will continue to grow their business, increase their sales, even in the face of a possible economic slowdown, especially when the housing market has been mediocre for the year.
Exactly. So as I pointed out, in their year performance, they have gone up 102%. My point on this is that their expansion plan. So to keep going and going after those top 25 metropolitan areas and focusing on those commercial businesses as well as their sales representatives, I think this company can continue to grow and has more of a momentum path.
Great, thank you.
Thank you.
I just want to add on to his question. Given the fact that I think 2/3 of the revenue is being produced by consumers, if that was correct, something along that line, 80%.
Yes, sir.
Expand a little bit more on the marketing distribution efforts of this company and how they are being able to penetrate the average consumer.
The average, could you repeat that one more time?
So in other words, back to the question is over 80% of the revenues generated by this company is coming from consumers.
Coming from residential.
Exactly, residential. So residentials require additional marketing efforts, unlike going to an industrial type clients. So if you, what was their marketing plan? How are they reaching the consumers?
They're reaching the consumers mainly by their two subsidiaries. So they're putting these sales representatives within these cities and going after contractors for these residential homes, which is helping them expand their sales over time, and that's why they've been expanding so much. So that's the way that they're really reaching out to these companies.
All right, so they're not reaching out to individual consumers, but they're going to the contractors.
Contractors.
Thank you.
Yes, sir.
Thank you.
Thank you.
Our next two presentations both come from the tourism industries. However, the companies are very different from each other. Camila Morales will be presenting Disney, followed by Tini Yadna, that will be presenting Marriott Vacations.
Good evening, everyone. My name is Camila Morales, and today I'm going to talk about one of the most strongest and successful companies within the media and entertainment industry, the Walt Disney Company. I would like to start by sharing with you guys a very short video about one of Disney's most current and strongest growth drivers.
Okay, everybody, let's take it from the top. Something's happening. Something extraordinary. Something exciting. Something authentic and true. Everything changes now. And snap. What's next? The future. That's our specialty.
Okay, so what did you guys see? Did you see and recognize some of the Disney's classics? Or did you recognize content from Pixar, Nat Geo, and even Marvel? Well, as a good Disney student, I recognize one of our best opportunities to make money out of this. This is the agenda I'm gonna follow tonight. Okay, Disney divides itself into 4 very strong operational segments. The first one is the media networks. This involves everything from cable, networking, broadcasting, and also radio stations. I need to mention that this is so far Disney's strongest revenue contributor. The second segment is parks, experiences, and consumer products. These segments involves everything from the parks to the resorts, even the cruise line, and the products. Not only the physical products, but also the patents and licenses. The third segment is the studio entertainment. This has to do with everything from live action to animation, the production and the distribution of these. Just as the products, it also involves the patent sets and the licenses. Lastly, we have the direct-to-consumer and international. So far, this is Disney's newest business segment. As you can see in this chart, it had to restructure a business segment just because it has done recently significant investments within the segment itself. Now, I must say that it's almost impossible to compare Disney only with one competitor. That's why we have, in order to compare it, we have to do it with different competitors on their respective segment. However, for the media and for the theme parks, I showed Comcast because so far it's one of the strongest competitors on those two segments. As you can see on the chart here, we see that Disney has been experiencing up to a 20% revenue growth in comparison to its competitor. Now let's see how the parks are doing. Not so great, right? But I'm gonna tell you why. The reason of this is because in the past, Disney has been doing a lot of significant investments within the parks. It has been releasing different zones and different attractions. Now let's see the direct-to-consumer industry. At the beginning of 2018, nothing that exciting was happening. The growth was steady. However, let's see what happened in 2019. Up to 30% growth. Let's see how it has done within the last 12 months. On the first point, we can see that the price increased because Disney released the news that it was going to bundle its platforms. Let's see what happened the second point. Well, the price dropped. The reason of this is because the company shared the news that the screenwriters of the Star Wars movies were going to be the same of the Game of Thrones. We see how that went. Okay, let's see what happened with the third point. Here the price dropped as well. The reason because of this is because the attendance of the Star Wars attractions were not as expected. However, let me tell you about last week. Disney rose up to a 30% on its performance. The reason of this is because it released Disney Plus, its new streaming platform. Which brings me to the point of growth drivers. It's not only the Disney Plus itself, but it's the whole streaming area that they have on their favor because of the bundling they can offer. In addition, taking into consideration the core cutting culture that society has been experiencing, what I mean is shifting from traditional television onto streaming, Disney is taking this into consideration. And let me give you a specific example how they have battled this with ESPN. As you can see on the figure on the top, on the bottom, from 2016 to 2017, Disney lost up to 4 million subscribers on your ESPN cable. When you lose subscribers, you lose a lot of money. Anyways, so from 2017 to 2019, the subscriber losses started stabilizing and they started losing only 1 million subscribers per year. Therefore, the losses decreased from 4% to around 2%. How did Disney offset these losses? Well, that's where ESPN Plus, the streaming platform, came into play. It really saved those subscribers. Now, some of the other growth drivers that Disney has in its favors are the movie industry, the entertainment industry. Just with The Lion King itself, Disney made up to $500 million just on the debut. As well, Disney has other movies that are very awaited by the public, such as Frozen 2, It Chapter 2, and Star Wars. Another growth driver that Disney has in its favors are the assets they just acquired of the 21st Century Fox. However, now let's talk about the risk. The main two risks that I identified are the licensee fee loss and the recession. Let me talk to you about the first one. Well, Disney is deciding to throw its own platform. Okay. What does this mean? That it's withdrawing its content from other platforms. This is going to cost them along 150 million loss just in revenue. However, on the long run, Disney could actually benefit from this. How? Well, because they would gain insightful data about the trends their viewers actually enjoy to see. Now let's talk about the risk that every company within the consumer discretionary industry faces. Recession. Well, as I mentioned before, Disney is very competitive within all its 4 segments. Therefore, because it has different segments all around the world, it has a natural hedge. Therefore, different segments in different locations are very likely to offset the losses. Movie entertainment. During the 3 out of the last 4 recessions that we have had, the movie entertainment industry actually increased. By this I mean that the domestic gross box office actually increased. But why? Well, because people during recessions are seeking for momentary pleasure. Therefore, people are very willing to spend up to $10 to $15 going to the movies or $7 by renting a movie. Now let's talk about the streaming bundles. As I mentioned, Disney is seeking to put together its 3 streaming platforms by a cost of $13 a month. Therefore, in a time like this, the consumers will be given the opportunity to have a diverse content library just for the price of $13. Therefore, they will be saving money. Now, allow me to quantify everything I just mentioned. Let's see the figure on the top. We compare the earnings of the estimates versus the actuals. As you can see, with the exception of the second quarter, Disney bet the estimates. But what happened in the second quarter? Where the earnings actually got diluted because in order to pay the debt that Disney has, they issued up to 305 million shares. Some of the analysts do not really like this. However, Let's see the figure on the bottom. The enterprise value of Disney actually increased significantly from 2015 to 2019. Free cash flows are an important segment of the business. The reason because of this is because it shows how much cash a company has available after the capital expenditures. Let's see how much Disney has as for now, $3.8 billion. It decreased significantly compared to the previous years that it maintained a range around $6 billion to $9 billion. You might ask why? Well, because Disney is trying to pay off its debt right now. We don't like that word. However, let me show you how Disney is handling its debt. Let's go to the figure on the top. Disney total debt is around $50 billion. However, it's not even 50% of its capital structure. And if that doesn't even convince you guys enough, let's see how it's doing it in comparison to its peers. The debt-to ratio of Disney's compared to Comcast and Viacom, it either falls within range or is significantly lower. Therefore, we can conclude by saying that Disney is actually handling its debt pretty well. I analyzed the recommendation of 34 analysts. The price ranges were from 115 with minimum to 170. And the price target, the fair value I found, was 168, and I'm gonna explain how I got it. In order to come up with this price, I used two valuation models. The first one is the discounted cash flow, and the second one is the Machiel's model. The reason because of this, that I use this, is because as cash flows and dividends, Disney has been having both of them stable throughout the years. Both of the target prices that I acquired was 168 and 169. Therefore, they do fall within the ranges that the analyst suggested. However, we went a little bit further, and I realized as an analysis where I saw how much would be in a pessimistic scenario, how much would be in optimistic. In a pessimistic scenario, we see that the price goes as low as 133. However, in the optimistic, we see that it goes from 183 to 194. But what does that mean for our portfolio? Well, in the worst case scenario, our portfolio would be only losing from 5 to 7%. We are expecting to make around 17%, and in the best case scenario, we would be doing around 27 to 34%. Therefore, considering that I chose a price target of 168 and that the current price is 145, I conclude by saying that the Disney company is currently undervalued by 17%. Because of how strong company Disney has been, and because it keeps bringing innovation to its consumers by products and different services, I recommend the Roland investment program to buy 500 shares of the Disney company. However, I would like to make a standing limit order. What do I mean by this? Well, as Disney released the Disney Plus, the price raised within 24 hours up to $10. This is likely to fluctuate within the next few months too, like what I'm saying. Therefore, I would like to recommend our trustees to buy Disney when the price reaches $145. Thank you very much. I would gladly answer any questions.
You're gonna go?
Yes, great presentation.
Thank you.
With so much focus on the US streaming market, how does Disney expect international assets, such as their leading streaming service in India, Hotstar, to perform?
That's a very fair question. Well, taking into consideration some of the statements on that company, they revealed that by 2020, they're hoping to try to focus also on Europe and Asia. More specific about Hotstar, like you asked, they're wanting to merge the Disney Plus, all their content, with the streaming service that they have right now.
Thank you.
Of course. Yes, Rafa.
Camila, thanks for a magical presentation. Disney Plus subscribers obviously surpassed analyst expectations, and the stock price has greatly benefited from that. However, streaming rivals are pushing back, for instance, Netflix's contract with Nickelodeon.
Yes.
Additionally, there have been questions of whether Disney can maintain and grow their subscription base. especially when some of these subscribers have used their 1 week free trial.
Yes.
Now my question, after your research and due diligence, what would you say about the future operations of Disney and what are your expectations?
That's a very great question. I would like to start by saying that as for now, the company hasn't really disclosed how many of those subscribers are the first week free trial. However, you're right, the contract with Nickelodeon and Netflix happened, as well as the HBO with Cartoon Network. However, they did fight back. They made a contract with Amazon to display the content on the Fire TV. In addition, they made a contract with Verizon. So, on summary, I would say that Disney has an advantage because they are offering a low price. However, we cannot disregard that the streaming field is also very competitive and it has so much advantage. What I mean by this is that there's going to be a lot of competitors. Therefore, there's going to be a lot of investment needed in the field. And that's something Disney has demonstrated that it's very capable of keep on doing.
Awesome, thank you.
Of course.
Question over here.
Yes, sir.
Given that Disney is such a very complicated worldwide company and multiple arrays of media entertainment, in your opinion, what is the single driver of Disney's profitability in the future that you're using to make your buy decision?
Right now, I base most of the growth rate that I gave to Disney on the streaming service. Why is that? Because a lot of companies are actually looking into that. They believe that's the future, and because during the last years, the shifting from traditional cable to streaming, it's just looking very favorable.
Okay, thank you.
Of course.
Do we have other streaming services in the portfolio or similar types of technology?
As for no, sir.
We get
Therefore,
one
we
point.
can buy it. Thank you very much.
Good evening, everyone. My name is Theory Yedina. We will be following the same roadmap template as we go along. Now, what we're looking at is the competitive profile of the world's leading timeshare company, Marriott Vacations Worldwide, or by its ticker VAC. VAC is an entirely separate entity that focuses primarily on luxury vacation properties. It has over 100 resorts, and these are the brands currently under VAC's portfolio. VAC is currently the best positioned timeshare within its lodging industry. And now I'm going to show you that their brand, Marriott Vacation Club, is one of the top leading vacation.
There's a whole world of fun out there. So what are you waiting for? Join over 400,000 families who've discovered the world with Marriott Vacation Club in the most amazing destinations you have ever imagined. Now with our newest innovation, the Marriott Vacation Club Destinations Program, a points-based exchange option, you will enjoy the flexibility to make your holiday dreams come true, even as your dreams change. And the kind of moments that can only come from personalized service that makes going on holidays easier than ever. It's all here, waiting for you. Flexibility, affordability, simplicity with Marriott Vacation Club.
Now, VAC operates through two segments, exchange and contract sales. And as we can see, the majority of their sales are coming from vacation ownerships, which is a great concern for investors who are wary of this impending recession that is coming forward. But VAC is a different company because of its customer base, which is the main source of its revenue stream. The customer base has a very high credit quality score, and they are in the high end of their network, and these are families coming from a high income bracket. They are essentially a demographic that is resistant toward a mild recession. And keep in mind that the management of VAC has been going on for 23 years. They have been through recession in the 2008, and they are setting high bars for the operations moving forward. And this is why I believe that even though VAC is currently in its maturity stage, it has room to grow. These are the 3 growth drivers that I've come up with. The new business model is they have their points-based system, and they operate it to give flexibility to customers. It recently acquired a competitive but a smaller firm called Interval Leisure Group, or ILG, which gives them a competitive step forward to expand their contract sales compared with their timeshare peers such as Hilton Grand Vacations and Wyndham. And management is also efficiently trying to source their inventory to increase their top line growth by having more destinations in. Now I want to pull your attention to the right side of this, the figure on this right side. Marriott operates through points-based system now, which allows their customers to shift their properties to other VAC properties. Having essentially created this economy with its points as its currency, Marriott offers borrowing as well as banking for their customers. Do you see how they're trying to capture not only their customer satisfaction, but also at the same time, if you look at the model on the right, on this left side, they're monetizing this resilient model, generating constant free cash flow, beginning from their stay to the purchase of their timeshare to the maintenance. And as with every large firm, VAC acquired another smaller firm, it's ILG, the ILG company. And as you can see, that the combined contract sales has increased significantly, and they obtained a CAGR that is higher than before. But of course, let's talk about risk. This is a consumer discretionary firm. So with any event that has to do with cyclicality, such as trade war, or even just natural disaster, could negatively affect the performance of VAC. And other 2 risks include their unsuccessful integration with ILG and inefficient execution of their digital initiatives to capture market opportunity. In spite of this, VAC has been outperforming the benchmark for the past 12 months. There was a slight dip in September 2019 because of the inventory sourcing issues that negatively impacted the whole lodging industry. But you can see it has picked up significantly fast and is now performing 50% above the benchmark. Now, after this acquisition, VAC actually have a really high change in revenue growth and in EPS growth compared to their peers. That is why these key metrics on the top, they're quite misleading. Their sales growth currently is at 52% and is the highest in their industry. And of course, before this acquisition, they acquired a lot of debt, which made them a very levered company. That is why for my critical assumptions for my valuation, I come up with some of the values that is very likely to be affected. Its weighted average cost of capital is very much likely to go down. The capital structure is definitely going to change. And because of that, the enterprise value will become more expensive. But as you can see from this graph, the current 2019 EV multiple is below the average trend line, which is a very attractive stock to buy. And the analyst sees this. Over 80% of the analysts recommend a buy on Marriott. And a low PE ratio in its industry says that it is undervalued, which means it is a very attractive stock to purchase it right now. And their target price is at $138 with a lower range of $107 to $164. So for my valuation, I use the EV multiple, and considering the pessimistic, expected, and optimistic scenarios, I come up with the target price of $136. And now I've made my point. VAC is a good company with a well-managed team. It has a resilient business model with a strong customer base, and is currently undervalued by 14%. This is why I recommend the Roland George Investment Program to buy 500 shares of Marriott Vacations Worldwide. Thank you.
Well, I was going to say that I
Yes.
really appreciate your analysis and it was very enlightening, but I always have to say that the two worst words I hear on my vacation is come look at a timeshare. but the numbers are very attractive.
Yes,
Thank
it
you.
is. Yes, Rafa.
Very great presentation.
Thank you.
Now my question, how did the VAC prepare itself to stay competitive against disruptive companies such as, in this case, Airbnb, that are currently changing the way people rent places to vacation?
Thank you for your question, Rafa. Well, this is a very popular question, and the people everywhere are asking this. Well, what you have to understand is that Marriott is targeting a different customer base, whereas Airbnb, they do target everybody. And another thing is the brand confidence that people have on Marriott. For Airbnb, you have to have a buyer beware position, because whenever you approach an Airbnb or go online, you want to make sure, you have to do your due diligence to have to settle with a good Airbnb host. But with Marriott, you don't have to. You have the trust in it. So I think that is how they stay competitive with these disruptive industries such as Airbnb. Yes, Tim.
You spoke a little bit about the Marriott Vacations Club's target market. I was curious if this target market is projected to grow over the coming years in order to sustain the same growth that we've been seeing since the beginning of the year.
Yes. So when we talk about Marriott, we think about people in the older generations because they prefer these timeshares. However, we can see from their investor day meeting that they're actually also targeting the younger generation who are in fact richer now than previous generations. So that is how they're targeting. And not only that, they're trying to increase their revenue mix through digital initiatives, which I've mentioned. Through Facebook and Instagram, all these advertising materials and social platform, they're trying to target and capture this market opportunity to increase their revenue.
Thanks.
Thank you.
Thank you.
Thank you.
Thank you. This concludes our presentation for tonight. Now, we would like to know your preference. Therefore, for the next 2 minutes, we will open up the voting to the public, which will be followed by the trustees voting. Oh, yes, to express your preference, you guys need to text the RGIP 321 to 22333, and then express your preference from A to B.
I need the audio. Oh.
Alright, it's time to vote. Alright. So please express your vote by raising your hand. First, we have Spectrum Brands. The recommendation was to buy 1,000 shares. All in favor? All against? The recommendation doesn't pass. Next, we have Top Bill. The recommendation was to buy 550 shares. All in favor? Recommendation passes. Next is Disney, with the recommendation of buying 500 shares. All in favor? Recommendation passes. And the last one is Marriott Vacations, and our analysts recommended to buy 500 shares. All in favor? All against? Motion does not pass. Thank you.